Hello and welcome to The Trade. Well, before we get to the charts, let's take a look at what's going on at a macro level. And Treasurer Jim Chalmers saying that Treasury was expecting headline inflation to hit the mid to high fours this year due to the Middle East oil price shock, well above the RBA's target range of 2 to 3%. The central bank is expected to lift the cash rate by 25 basis points to 4.1% when it announces its policy decision tomorrow. In the US, consumer spending increased 0.3% in January amid higher prices, while the Middle East conflict is forecast to add to inflation. Retail gasoline prices have soared more than 21% since the war began 2 weeks ago. Economists expecting the Fed to keep interest rates on hold while signalling rate cut delays when it meets this week. US Treasury yields were mixed on Friday. The 2-year was down slightly at 3.73, the 10-year at 4.28. Australian 3-year government bond yields rose to 4.6%. The 10-year touched 5%. Markets are priced in a 70% chance the RBA cash rate will be hiked this week, with a 100% chance by May and around 3 hikes in total by the end of this year. And the US dollar index rose more than 0.5% on Friday. Risk aversion has dragged on the Aussie. It's currently at 70.1 US cents. Let's now turn to the technicals with a focus on energy. Michael Gable joining us from Fairmont Equities. Michael, welcome to you. That is the only game in town at the moment, isn't it, given what we're seeing with the oil price, and no one knows how long this conflict is going to drag on for, but obviously we're seeing the dramatic effects in global energy supply. So let's take a look first off with a look at that oil chart.
Yeah, so I was here in mid-January talking about oil and energy, and at the time I said that I thought the energy sector was the biggest opportunity for this year, and I think the events in Iran have just accelerated that whole thesis. So we're looking at the breakout of oil in January, so you can't quite tell on this monthly chart, but it was starting to break out before war started, and obviously with what's happened in the past couple of weeks, we've seen prices spike above $100 US. So when we look at the monthly chart, we could see that it has clearly bounced off those lower levels. It is heading back up towards areas above 100 have proven to be resistance in the past. But I think the ingredients for why I thought prices would rise over the course of the next few years is still there. So what that means is, although we might get some resistance in the low 100s, there is a possibility that it does eventually break higher than that and enter a new higher trading range. So it's been over 20 years since we've had the last major bull market in oil, and as I said back in January, there were a lot of supply concerns when it came to oil. Demand was still there, and this will, what we're seeing, even if we feel like we're getting a resolution this week and the Strait of Hormuz is reopened again, obviously a lot of damage has been done, and a lot of attention will come back to re-establishing oil reserves. So demand will be high for a while, and supply is going to continue to be an issue.
Well, let's see how this is translating in terms of the largest energy stock listed locally, of course, being Woodside, which, well, let's face it, its focus is on gas, isn't it?
Yeah, oil and gas, they're very leveraged to the rising oil price, but what you'll find is that because investors are very underweight energy. So as I was saying back in January, even looking in the US, the energy sector used to account for about 11 to 14% of the S&P 500. It was down to 3%. So everybody's just neglected the energy sector, and that's the same here in Australia. So as investors start focusing on, well, I need some energy exposure because I don't have any. So I hope eventually everyone will stop talking about when's the great time to buy PME and Zero, and they'll realise, well, hang on, we need some energy exposure. Woodside's going to be the go-to stock. So if you want some, early upside, it's Woodside. This is a weekly chart. It's having a run up to the high 30s. I think it'll achieve that in the next several weeks. That's that blue line there. It'll consolidate, but I wouldn't be surprised if at some point it breaks beyond that, because higher for longer prices of oil and gas will boost the profits of Woodside. So, and this is going to segue into our other stocks. Higher oil prices won't just be higher energy prices won't just be constrained to oil, it'll flow into other commodities, other sectors of the energy complex as well.
Well, let's go there then. Uranium. Now, obviously, uranium has moved, particularly given the demand that AI is creating, data centers and how they're going to be powered. And I mean, that's been a focus elsewhere in the world with nuclear reactors. So how has uranium performed, particularly since this conflict began?
I mean, uranium's performed quite well over the past several months. I mean, since the conflict began, it hasn't moved yet. It's been, I guess, uranium stocks have just been caught up with other stocks. They've just been sort of tossed out while everyone's been focusing on oil. But if we think beyond the short term, as the price of oil heads higher, it'll have a flow-on effect to the other commodities. So, oil makes everything more expensive. We're already seeing that the rollout of renewables is being delayed. The cost to build more wind farms and solar farms will only increase with a higher oil price. So countries will look for other alternative forms of energy, and they're already doing that, and that's in coal and uranium. So here's a fantastic looking chart. This is Bannerman Energy, a uranium developer. So this is a monthly chart that I've converted to a log scale, and I did this with silver about a year ago because it demonstrates a very bullish pattern, and that's the cup and handle, which is basically the blue pattern on the far right hand side. So to me, it looks like it's building up for a very strong move. It was almost about to break out of that pattern a few weeks ago before the war started. I think that the buying will emerge again pretty soon, and if you see a break above $5, I think that could add a few dollars on top of that. So Bannerman Energy, it's a smaller one, Aussie developer in Namibia, but looking very bullish.
Well, let's stay in Namibia. Paladin is the most prominent locally listed stock then. What are you seeing with Paladin?
Yeah, Paladin's looking really interesting here. So it's had a fantastic run since the April lows last year. Been recovering really well. Every now and then it has a very strong move, but then it does give quite a bit of that back. So these stocks are volatile, but at the moment it does look like it's in a consolidation phase. I'm indicating that with the blue lines at the top right hand side. So essentially it's just tracking sideways to consolidate that massive move from December, January. It's towards the bottom of that range, so I'd say that it's a buying opportunity here. I think if it breaks above that blue line, which is just above $14, you'll see a quick run up into the $17, $18 region. So look, there are a number of catalysts for uranium this year. I've covered it previously on this show, but Paladin's one way to gain that exposure.
All right, and let's move further across the energy complex with a look at coal. That's also benefited recently too.
Yeah, exactly. So you mentioned the rollout of data centres. Again, in an ideal world, we'd have them powered by the renewables. But as data centres are being rolled out and the rollout of renewables is not quite meeting expectations, part of that gap's being filled with coal. So whether we like it or not, that's the reality. In the US, we're still seeing coal power stations being built in China at a great rate of knots. And the interesting thing with the coal space is that, because coal's a dirty word, there's really no investment in new coal mines. So if you've got a coal mine, you're sitting on a gold mine, really. Probably not the best analogy, but so as we could see, coal prices, the coal stocks are starting to break out, and I suspect coal prices will really ramp up as countries look for alternative forms of energy. So Whitehaven coal, we could see on the left-hand side, it had that massive run in 21-22 with the outbreak of the war in Ukraine. We could see it's consolidated for a few years. That's in those blue lines, and then it's started to break higher. It's doing that now. I suspect we'll see significantly higher levels in Whitehaven coal from here.
All right, and a look at New Hope?
Yeah, pretty much the same looking chart. So this is one that I've got my clients exposed to. Same sort of pattern. It's had a bit of a run. It's consolidated. Actually, I brought this chart along in January when I was here talking about the energy sector. I've circled there on the right hand side the breakout. So for me, New Hope Coal is still a buy on any dips. It'll be pushing to new highs, I think, by the end of the year.
Michael, great to get across what you're seeing in the energy space with the focus on those technicals. Thanks for joining us at Fairmont Equities.
Thank you.
And that is the trade.